Welcome to the Tech Stocks Daily Podcast, where we dive into the latest movements and trends in the technology stock market. In today's Tech Spotlight, Google has once again captured headlines with its foray into the labyrinthine world of artificial intelligence. This time, it's about an intriguing strategy where Google entices publishers with a generous 5-figure stipend to test an unreleased GenAI platform. Here's the scoop. Alphabet Inc.'s technologic titan Google has reportedly kicked off a private program targeting a select group of independent publishers, offering them beta access to an as-yet unreleased generative artificial intelligence platform. The catch? In exchange for this exclusive sneak peek, these news organizations are anticipated to shed light on analytics and feedback, providing valuable insights back to Google. Digging deeper into the terms of this unusual bargain, it's outlined that participating publishers are saddled with the responsibility of utilizing AI tools to churn out a certain quota of content over a year's span. But it's not all for naught. In return, they're gifted a monthly stipend, accumulating to a handsome 5-figure total annually, alongside the means to produce content highly relevant to their readership without dipping into their pockets. Leveraged by this AI platform, publishers can now aggregate content more efficiently, indexing and summarizing freshly published reports from other organizations before delivering these as brand new articles. This initiative is a branch of the Google News Initiative, conceived in 2018 as a gesture to arm publishers with cutting-edge technology and training. The year-long escapade commenced in February, with requirements for participants including the production and publication of 3 articles daily, a weekly newsletter, and a monthly marketing blitz. In response to inquiries, a Google spokesperson framed this experimental tool as being responsibly designed to help small, local publishers produce high-quality journalism using factual content from public data sources, ensuring that the publishers hold the editorial reins tightly, affirming that these tools are by no means a substitution for the indispensable role of journalists in the reporting, creation, and fact-checking of articles. This move is symmetric with Google's enduring efforts to polish its AI capabilities. Despite facing its share of controversies, such as the flack over its Gemini AI chatbot's historically inaccurate outputs, Google's firm belief in AI's potential to revolutionize content creation remains sure-footed. This initiative could be seen as a bridge to mend relations with the publishing world, mitigating AI's bizarre behavior, as cited by Mark Andreessen, and demonstrating a strong commitment toward empowering high-quality journalism through AI-enhanced productivity and innovation. Today's tech news brings Snowflake Inc. into the limelight, and it's not because we're heading into winter. Snowflake, a cloud-based data warehousing company that's been a buzzword in the tech and financial sectors since its spectacular IPO, made headlines due to its impressive fiscal performance and a significant stock upgrade. The center of attraction is Snowflake's fiscal first quarter earnings report, which not only beat Wall Street's expectations, but also showcased a revenue jump of 46% year over year. This leap in revenue underscores Snowflake's continuous growth trajectory and its expanding market footprint within the cloud data services sector. In the nitty-gritty, Snowflake reported losses of 43 cents per share on an adjusted basis. But what's thrilling here is the revenue side of the tale. The reported revenue of nearly $700 million for the quarter was a bright spot, especially when weighed against analysts' expectations, which were pegged slightly lower. Now let's talk stocks, because why not? Riding on the coattails of this stellar earnings report, Goldman Sachs stepped in and upgraded Snowflake stock to buy from neutral, sending a clear bullish signal to the market. Not just a nod of approval, Goldman also went the extra mile by hiking the price target for Snowflake stock to an eye-watering $210 from the previous $184. This vote of confidence from Goldman Sachs is akin to a spotlight shining on Snowflake's strong performance and future potential. It reflects the analysts' belief in Snowflake's capability to maintain its leadership position in the cloud data warehousing space, benefiting from the ongoing digital transformation wave sweeping across industries. So why was Snowflake in the news today? To sum it up, stellar fiscal performance, with revenue skyrocketing and beating expectations, coupled with a significant stock upgrade from Goldman Sachs. For Snowflake Inc., it seems the forecast is looking decidedly less chilly, hinting at sunny days ahead in both its financial health and stock market performance. Today, in the tech and finance arena, Autodesk Inc., the renowned software company behind AutoCAD, grabbed headlines for a significant shift in its fiscal projections, which subsequently led to a sharp decrease in its stock price. The company, a giant in design software for the architecture, engineering, and construction industries, revised its full-year earnings and revenue outlook downwards, stirring a wave of reactions in the market. Autodesk's update came alongside its fiscal first quarter earnings report. Initially, the company had set high expectations for its financial year, projecting robust growth and financial performance. However, as the latest report unfolded, Autodesk announced a cut in its full-year forecasts for both earnings and revenue. This adjustment was attributed to a projected slowdown in customer growth and spending, echoing broader concerns about economic uncertainties affecting global markets. In detail, Autodesk now expects to see adjusted earnings per share range between $16.43 to $6.66 for the fiscal year, a step back from its earlier projection. Similarly, revenue expectations were scaled down, with the company now anticipating figures to lie between $5.41 billion to $5.46 billion. This recalibration of expectations led to a significant dip in Autodesk's stock price, as investors reacted to the news. The revised outlook has injected an element of caution into the market's view of Autodesk, with concerns about how the current economic climate might impact its operations and growth prospects. The market's response to Autodesk's revised projections was swift, reflecting the high degree of sensitivity to changes in earnings and revenue outlooks, especially amidst an environment of economic uncertainty. For Autodesk, this adjustment marks a moment of recalibration as it navigates the challenges posed by a potentially cooling market for its range of software products. In sum, Autodesk Inc. made waves in the news today not for product launches or acquisitions, but for a significant revision to its financial outlook, underscoring the intricate relationship between corporate projections, market expectations, and the ever-looming shadow of global economic trends. Rounding off today's tech news blitz, Electronic Arts EA, the powerhouse behind fan-favorite franchises like FIFA, Madden NFL, and The Sims, has made headlines for a reason that's sending shockwaves through the gaming community and Wall Street alike. The buzz? EA announced a substantial round of layoffs affecting 6% of its workforce. This move, as stated by the company, is part of a broader restructuring effort aimed at sharpening its focus on new technologies and gaming experiences. EA's CEO, Andrew Wilson, conveyed this tough decision through a company memo, pointing out that the gaming landscape is rapidly evolving, with new technologies redefining how and what games are played. This evolution necessitates an adaptation in their strategy and operational structure to not only meet, but exceed the expectations of their global community of players. This decision comes at a time when EA reported solid earnings for the past fiscal year, with notable successes in its major titles driving revenue. However, amidst this financial backdrop, the announced layoffs highlight a strategic pivot as EA aims to position itself at the forefront of the gaming industry's next phase. The company stressed its commitment to assisting affected employees through this transition, including severance packages and other support services. EA's move has sparked a flurry of discussions raising questions about the future of the gaming industry, the role of emerging technologies, and the implications for workforce dynamics within major gaming studios. Now, we'd love to hear your thoughts on this. What do you make of Electronic Arts' strategic pivot and the implications for the future of gaming? How do you see the role of new technologies shaping the industry? And what might this mean for the broader landscape of game development and the communities built around these major franchises? Drop your comments, insights, and predictions down below. Let's get the conversation rolling on where EA and the gaming world are headed next. Today's market sentiment feels like a roller coaster ride through the technological and financial landscapes, reflecting a mix of optimism, caution, and strategic recalibrations by heavyweight companies within their respective industries. On the bullish side, we have Google dazzling the market with its forward-thinking approach to artificial intelligence. Through its generous stipends to publishers for testing an unreleased AI platform, Google not only underscores its commitment to advancing AI technology, but also reinforces its role as a catalyst for innovation in content creation. This move, indicative of Google's optimistic outlook on AI's potential, has likely bolstered confidence in the tech giant's future endeavors. Snowflake Inc. rides a similar wave of positivity, with its impressive fiscal performance and the subsequent stock upgrade by Goldman Sachs painting a picture of a company on the rise. Snowflake's ability to outperform expectations amidst the digital transformation cements its place as a leader in cloud data warehousing and exemplifies the optimism surrounding cloud-based solutions. However, not all news today points towards clear skies. Autodesk's announcement of revised full-year earnings and revenue outlooks introduces a note of caution. The software giant's acknowledgement of a potential slowdown in customer growth and spending reflects the broader uncertainties lingering over the tech sector, possibly tempering market enthusiasm with a dose of realism. Adding complexity to today's sentiment, Apple's massive stock buyback announcement and increased dividend alongside a mixed earnings report signal both strength and the challenges ahead. Apple's move reflects confidence in its financial health and future prospects, yet the slight dip in quarterly revenue serves as a reminder of the economic and supply chain challenges facing even the most robust of tech titans. Lastly, Electronic Arts' announcement of significant layoffs amid strategic restructuring efforts hints at a deeper industry-wide evolution. While EA's pivot towards embracing new technologies for future gaming experiences might excite some, it also introduces apprehension about the immediate implications for its workforce and the broader gaming community. In sum, today's market sentiment is a tapestry of optimism tinged with caution, as major players navigate technological advancements, economic uncertainties, and strategic shifts. The tech and gaming sectors, in particular, are at a crossroads, facing both tremendous opportunities and notable challenges ahead. Reflecting on today's news, I'd focus on Electronic Arts, EA, as a stock to potentially hold. Here's the rationale behind this decision. Electronic Arts announced significant layoffs, affecting 6% of its workforce, as part of a broader restructuring effort to focus on new technologies and gaming experiences. While layoffs can often be perceived negatively in the short term, potentially affecting market sentiment and stock performance, EA's underlying reason, strategic realignment towards future growth areas, could bolster long-term prospects. This restructuring indicates EA's intention to adapt and stay competitive in the rapidly evolving gaming industry, which could pave the way for innovative developments and financial growth. However, it's also a move that brings uncertainty, with the immediate impacts on productivity, morale, and overall strategy execution yet to be fully understood. Given EA's solid track record and financial performance, particularly highlighted by its successes in major gaming titles, investors might view the current situation as a momentary dip within a broader narrative of growth. For those already holding EA stock, it may be prudent to wait and observe how the company's strategic restructuring unfolds and whether it translates into enhanced market positioning and financial improvement. Please note, it is crucial to conduct personal research or consult with a professional financial advisor before undertaking any investment decision. In summary, holding EA stock could be a measured approach for investors who are looking to see how EA's strategic shifts resonate within the dynamic gaming industry and translate into financial performance in the medium to long term. In today's tapestry of tech tales, we've got something that's not just interesting, but downright futuristic, maybe even a bit comical, depending on how you look at it. Apple Inc., the behemoth behind your iPhones and MacBooks, once dreamt up an electric vehicle (EV) project that was, let's just say, unconventional in its approach to driving. According to a New York Times story, Apple's now abandoned EV project, codenamed Titan, envisaged cars with no steering wheels. Yep, you heard that right. Instead of traditional steering, these cars would have been maneuvered by none other than Siri. Imagine telling Siri, "Hey, take me to the nearest coffee shop," and sitting back as your car obligingly veers towards your caffeine fix. This ambitious, or perhaps audacious plan was part of Apple's exploration in the automotive sector beginning back in 2014. The vision was so futuristic that it included designs resembling a European minivan, like the Fiat Multiple 600, replete with a voice actor scripting Siri's responses as if you were cruising down the road in this imaginary, steering wheel-less car. Alongside these details, it was revealed that Apple had once eyed a partnership with Tesla, a move that could have dramatically altered the trajectories of both companies. But, as fate would have it, Apple's automotive ambitions hit a roadblock, and the Titan project was ultimately parked. Listeners, what's your take on this? Can you picture a world where Siri doesn't just manage your schedule and play your favorite tunes, but also drives you around? And what about that potential Apple-Tesla partnership? Are we looking at a missed opportunity of epic proportions, or was it all just a pipe dream? Drop your thoughts and comments. It's not every day we get to ponder a future where your car might politely decline to take you somewhere because it doesn't align with Siri's latest update. That's a wrap on today's market activity, folks. From Google's bid to revolutionize content creation with AI, to Snowflake's financial triumphs, Apple's strategic stock maneuvers, Autodesk's cautious outlook adjustment, and EA's bold restructuring move. Not forgetting Apple's almost whimsical venture into Siri-controlled cars, today has certainly been a roller coaster of innovation, strategy, and a hint of the unusual. We've navigated through highs and lows, surprises, and expectations, reminding us of the dynamic and ever-evolving nature of the tech and financial landscapes. As we saw today, the journey towards innovation and growth is filled with strategic adjustments, and sometimes a bit of whimsical dreaming. If today's story sparked your interest, piqued your curiosity, or just kept you entertained, don't forget to hit that like button, subscribe for more gripping tech and market news, and share this video with friends and fellow tech aficionados. Your support helps us keep this conversation alive and kicking. Be sure to join us again tomorrow for another round of summaries, insights, and discussions on the latest in tech and markets. We've got plenty more where today came from, and you won't want to miss what's next. Until then, keep exploring, questioning, and sharing the wonders of tech and finance. Catch you in the next video.